for questions and tell people how to ask them, please.
Thank you, Michael. Yes, I can confirm it's not my boat. It's definitely not my boat. And we just want to say first, Michael, you've reached an unprecedented level of popularity. 2021 must be your year. And so for those of you who were able to tune in today, we actually had a maximum participant count that we weren't expecting of 100. And we've never had that before. And so for those that attended, thank you. You were one of the 100 that got in, and we'll have this recorded for those who are just tuning in later. So we had Ken write in actually before the presentation started. So very keen to ask Michael, if you could kindly explain withholding taxes and dividend tax credits applicable to dividends paid from Canadian and US ETFs and stocks bought on the US stock market.
Right. Okay. Well, whether you buy the stocks on the Canadian or US stock market, if it's a Canadian company issuing Canadian eligible dividends, for example, Toronto Dominion, which is listed on both stock markets, in that case, there is no withholding tax. And the dividends, whether they're in Canadian or US dollars, are treated as Canadian eligible dividends. On the other hand, if you buy US stocks on the US market, or you buy a US stock ETF on the Canadian market, it is subject to withholding tax unless the funds are held in a RSP or RIF, because there's a tax treaty between Canada and the United States that exempts tax in retirement accounts. TFSA is not a retirement account, RESP is not a retirement account. And those American dividends are subject to a 15% withholding tax. Now, sorry, this gets complicated. When you file your Canadian tax, you get to claim the American 15% withholding tax against your Canadian tax. So essentially, it evens out. However, the one case where you do not get it back is in a TFSA. And a TFSA, because you're not paying any tax on it, there's no way to get the 15% back. You lose it. So basically, avoid US owned securities companies in a TFSA because if you can, unless you're going strictly for capital gain, something like Berkshire Hathaway that doesn't pay a dividend, because otherwise you're going to lose 15% off the top. I hope that's clear.
Great.
Hey, do you like the hat, Sarah?
I love the hat. I'm just sad that I didn't bring a hat today. I'm wearing the imaginary hat of fill-in host.
Okay.
Your next question, Frank, is from Francine. What is a yield?
What is a yield? Okay. Yield is simply whatever an investment pays you. So, for example, if you have a TD and it pays a dividend of 4.5%, that is the yield. If you have a real estate investment trust that pays 5%, that's the yield. If you have a GIC that pays 1.5%, that's the yield. So the yield is simply the distribution, the money that you're paid. It can be made up of different components. It can be dividends, it can be interest, it can be capital gains, a bunch of things. But generally, when we look at just what is the distribution, and we talk about it usually on an annual percent basis, that's the yield.
And I've just seen another question that asked, is a trailing yield the same as a yield? So staying on the topic of yield for a moment.
Yeah. The only difference is that a trailing yield means what the investment yielded over the past 12 months. So it's not trying to estimate what it will yield in the future, but it's saying over the last 12 months, it yielded 4.5%. So trailing yield is usually used in place of yield because it's certain. People know what it is.
Great. Rod was wondering, with markets at all-time highs, what are the risks of investing in passive ETFs versus actively managed? And how can investors protect themselves?
Well, you know, that of course is always the, what, $10,000 question, $20,000 question. You know, it's, as I said earlier, who knows what markets are going to do? I mean, it's hard to believe that in the middle of a pandemic that's killed, what, 330,000 Americans, where in California, they're getting 50,000 new cases a day, where you just had an attempt almost at taking over the US government, that the S&P 500 is at a record high. So trying to figure out what's going to happen is, frankly, it's a mug's game. I don't know what's going to happen, and clearly nobody does. So how do you protect yourself? You basically take a very diversified approach, and you make sure that you've got, you know, a balanced approach to your investments, which is why something like VBAL may be appropriate for people, because it's got stocks of the world, bonds of the world. Going back to the active versus passive argument, it has been shown that in broad-based investments or indexes like the TSX or the S&P 500, it's almost impossible for actively managed funds to beat the index. 95% over a 10-year period do not beat the index, which is proven. However, there are certain areas where having a brain making some decisions, I think, does make sense. And it makes sense in two cases. One, where the fee that's being charged is very reasonable. And in fact, where you find that the fees are low, below 1% for sure, then a certain number of actively managed funds can beat the index. So the main problem is the fee. And the problem with most Canadian mutual funds actively managed is that the fee is well over 2%. It's too high. The other area where it seems to work is in specialty areas where there's not a huge number of companies. So I mentioned the RIT ETF, which is actively managed. It's only got 20-25% companies in the whole ETF. And clearly there are some brains there picking the winners, the right ones. The MER on that is, I believe, around 0.75. And I think paying 0.75 for smart people managing investments is not bad. Finally, if you look at the VBAL, which is kind of an actively managed ETF because they decide what the mix is going to be, different countries, different types of bonds, the MER there is around 0.25. And again, paying 1/4% for brains managing your investments, I think is very reasonable.
I think so too. So Sally wanted to know, is personal income level for an individual or for a couple?
Individual. Because we don't file in Canada joint income tax like we do in the States. In Canada, it's all your personal income. So this is personal taxable income. And I believe it's, I'd have to double check on this, but I believe it is after income splitting. So say that one person has got a public service pension, splits that with the other person who doesn't. I believe, but double check this, that the taxable income is calculated after the income splitting.
No. Mike was wondering, what is the latest on government's intention for capital gains taxation? Do you know anything about that, Michael?
Yeah, I called Justin earlier this morning to ask, but he said, look, I'm sorry, I'm still distributing vaccines. I haven't got to that yet.
Right. That is something definitely that I think Michael's watching, though. We've had a couple conversations around how are they going to pay for the pandemic? What does that look like? So I think we're all eagerly, like you, Mike, wanting to know what's going to happen there, but nothing so far.
Yeah. Here's an interesting factoid. Only about 10% of taxpayers pay capital gains tax. On the other hand, an awful lot of retirees depend on dividends. So if they're going to tax something, and they've got to tax something, and they don't want to be putting up tax rates too much, increasing the capital gains inclusion rate is a nice way for them to do it, where they say, well, we didn't put the tax rate up, and we're actually only taxing more, about 10% of the population, who aren't going to vote for us anyway. So I don't know, but I would say there's a risk.
I think Mike, if Michael does know, he'll share it at next one of the future presentations. If we
when
when
Justin lets me know, you'll be the first to know.
There, you've heard it here first. That'll happen. Adrian wanted to know, do you have thoughts on retirement income funds such as VRIF?
VRIF, yeah. I'm not sure about that, to tell you the truth. That's an interesting one. And I'm going to do some more study on that for the session that we're going to do on managing retirement income fund investments. But right now, I haven't really been able to look at it closely enough to see what advantages it has over just something like a balanced ETF like VBAL. So my answer is the jury's still out as far as I'm concerned. But let me get back to you when we do the webinar on registered retirement income fund management.
Okay, so Adrian, watch this space for more answers in future. Al is wondering your view of using self-managed investing vehicles such as Questrade versus a broker.
Yeah, my feeling is that 95% of retail investors should probably use a fee-based advisor. Okay, so not so much a broker, but a fee-based advisor. But it's got to be a fee-based advisor who has the proper credentials and background. So a certified financial planner, somebody who uses broad type investments like low-cost ETFs, and certainly somebody who's going to charge you 1% or less for the service. But I think that most people, including myself, might be better served with a good fee-based advisor. But it reminds me of a experience I had. I was chatting with somebody who was going to one of the big brokerage firms to set up a fee-based advisory service. And they told her that they refused to use ETFs, exchange traded funds. They wanted to pick individual stocks because they could beat the market. And she was wondering about this. And I didn't say this to her at the time. I thought about it afterwards. But if you ever face that, here's what I would do. I would say to them, okay, tell you what, I'll make you a deal. For every dollar by which you beat a good broad-based index ETF like VBAL, for every dollar you beat it, I'll pay you 20%. Not 1%, 20%. But if you don't beat it, you get nothing. And see how many would take up that offer. And I suspect the answer would be close to none. So it goes back, yeah, I think having good advice makes sense, but it's got to be fee-based, it's got to be reasonably priced, and it's got to be somebody who's got the right investment strategy, which as far as I'm concerned, means using broad-based ETFs for the most part.
That's really good. And Al, I'll just take a promo opportunity that your newsletter should be emailed out to you this morning. And on January 27th, we're actually hosting a webinar in conjunction with RBC, which is DIY, do it yourself versus working with a professional. So that might have some interest to you, Al, and that's on January 27th. Look in your newsletter for that. Next question is from Solly. Do all charities accept appreciated investments, and how do we do it?
Most substantial charities will do it, will accept it. You know, if you're donating to the local church, probably not. But if you're donating to any major charity, yeah, they'll do it. How do you do it? You call them up and you say, hey, you know, I'd like to donate $100,000 of appreciated stocks to you. And what they do is they simply get their investment advisor talking to your investment advisor, and they arrange the transaction. It takes a couple of days and very easy. One example I'll give you, and it happened in our own life. My dad, before he passed away a few years ago, wanted to make a contribution to one of the universities in Moncton, where he grew up and had his business. And in going through his portfolio, I discovered that he had some Canadian Pacific shares, which at the time were selling for several $100s a share. And his average cost on them were $5. So he bought the things, I think, back when they were still using coal. Anyway, if he had sold those before transferring the shares, he would have paid a huge capital gains bill in the order of 27% of the whole gain. And it would have reduced the amount that he could contribute. But because he contributed the appreciated shares, he didn't pay any tax on it, and he got the much larger deduction for the charitable contribution. And in dealing with the university, they organized the whole thing in 48 hours. It's amazing how flexible people can be when you offer to give them money.
We have another question, Michael, from Margaret, saying that you've suggested in your presentation to top up TFSA to a maximum. She's curious what happens after your death, and is it suggested to name a beneficiary?
Well, when you set up a TFSA, you're asked to name two things, actually, a beneficiary and also, and I forget the exact term for it, but also almost like a second in case of beneficiary. So if your beneficiary passes before you do, or at the same time, it goes on to the next person. And the nice thing about TFSAs is they pass outside your estate, they go directly, and because they're TFSAs, there's no tax. So in case of your passing, it goes directly to whoever you designate, tax-free, and it happens virtually instantly.
There you go. I hope that answered your question, Margaret. I think it's Sonja asked, didn't realize that the topic was focused more towards non-registered accounts, and was wondering, could some of these model portfolios or stocks and ETFs be appropriate? Appropriate for TFSA?
Well, the answer is yes. In general, they can, because these are portfolios that generate income, and a lot of people want to use their TFSAs to generate income and then take it out tax-free. So anything that generates a reasonable amount of income today is, potentially appropriate for a TFSA. One mistake I think a lot of people make, and I did too when I first started out, was putting very low yielding things like GICs into a TFSA, which doesn't make a lot of sense. You should put in the things that you expect to have the highest yield, because then you're going to get the money free, because it's all growing free inside that TFSA. So yes, I think that these portfolios could easily be used inside a TFSA.
Great. So I hope that answered your question, Sonja. William would like to know, how should income splitting between couples fit into the dividend picture?
Well, that is getting into more of an accounting type of situation. But I think what you need to do is use tax software, which a lot of people are using, and run a couple of scenarios. using your tax software to see. So run a scenario where you put in all your data and you do it with income splitting, and then run a second scenario where you don't do income splitting and see how it affects your overall tax bill. Because the tax situation is so complicated today that trying to figure out these things without using tax software is virtually impossible. I know in my case, when I did this, ran the two scenarios, my savings from pension splitting in terms of our total tax bill between my wife and I was in excess of $5,000 that we saved. So, but I don't know if that applies to everybody, and everybody's situation is different and personal. So as I say, run a couple of scenarios using your tax software and see what happens.
And that savings didn't buy you one of those boat motors, Michael, but you're on your way then. You can put it aside.
It might have bought the gas for a weekend.
That's right. Alan has just a good, I think, general question. How do you minimize investment fees?
Well, first of all, shop around. It's amazing how they can differ. But there are companies in Ottawa who are fee-based companies. You can Google them, look them up online. Just Google fee-based investment advisors. One company that I know of that I'm not recommending, but is a good place to start, is called PWL Capital. And talk to people like that and get a sense of what they charge. And it will depend on the size of your investment account. Typically, the larger the account, the less the fee will be as a percent. But if you can start with somebody who's got a good reputation, who deals in index ETFs as a place to start, get a feel for it, and then it's like anything else, you can negotiate. I have heard of cases where people, I think were being charged way too much. I remember at the end of one seminar a couple of years ago, someone came to me and asked if they were paying too much. And I said, look, I don't want to pry too much, but this range of things, how big's your investment account? Is it over $1 million? And he said, well, it's several million. And I said, okay, and what's your fee? And he said, I'm paying 2.25%. And I said, you're being ripped off. At that sort of a level, you should be paying less than 1%. So, as a guide.
That's a guide. I can't say that I have an investment account with a few million in there, but I'll know that 2.25% is too high if that day ever comes.
Good.
Another question for non-registered accounts and registered, would you choose VDY or banks like TD? I think they're asking around what type of banks. Of course, we wouldn't recommend any specific banks in this, but it looks like the question's between VDY or larger banks.
Yeah, it's hard to give a specific recommendation, but generally speaking, as I said, I think people are better off owning well-diversified exchange-traded funds that are low cost and give you good diversification. So in general, I think people are better off buying something like VDY, which gives you this diversification, than trying to pick individual company stocks. I know I've been trying to do it for years, and the basic conclusion I've come to is that it's too hard. You got to realize that you're competing with pros out there who are making, $500,000, $1 million a year. And, I liken picking individual stocks to going up and having a game of pickup hockey with the Ottawa Senators. They may be the worst team in the league. Oh, not this year, but in past years. But they're still going to whomp you because they're pros and you're not. And I don't know why people think that they can be competing with pros picking stocks. I mean, would you go and fix your own teeth? Would you go and, do your own gallbladder operation? I mean, would you go and build your own house? No, you're not a pro at these things. Well, we're not pros at stock picking either. So my take on it is don't do it.
That's a good take, I'd say. Another question was for retirees. What is your feeling on portfolios of ETFs as the dividends seem low? Not sure if that question, if you can answer that.
Well, again, the same thing. The dividends aren't actually that low. I mean, if you can get a dividend ETF paying 4.5% in a diversified portfolio, that's pretty good. You can, as I say, you can make the decision to buy individual shares like Enbridge, but Enbridge is paying 8% for a good reason, and the reason is that people think that there's a lot of risk out there. If Enbridge wasn't perceived to have a lot of risk, the price would be higher and the dividend would be lower. And for us retirees, there's no great reason we should be taking on a lot of risk. I mean, you have to ask yourself, if I make an extra $10,000 a year, is that going to really change my life? And the answer is probably, it might make it a little easier, but it's not going to change it. On the other hand, if you lose 20 or 30% of the value of your stock you just bought, which is quite possible and happened this year, is that going to change your life? And the answer is, well, it might change it a lot more. So going back to the same answer, the question before, I preferred a diversified approach and not have to worry about individual stocks and individual companies.
Michael, there's a comment here, but I find it an interesting one from Francine that just says, paid advisors now require that the customer invest at least $1 million. I'm not sure if maybe that was related to the presentation, but can you speak to that at all? Is there a minimum investment for paid advisors?
It depends who you go to. If you go to the big bank brokerage firms, I've heard that their minimum is now $500,000. And maybe there are individuals who just say, if you don't have $1 million, I'm not interested in you. Because the thing is, think of it this way, $1 million, 1%, $10,000 a year. That's a lot of money to you, but to a big brokerage firm, $10,000, got to split half of it with the investment advisor, half goes with the firm. It's not a huge amount of money. But there are certainly firms that will take accounts that are smaller. And there are also a lot of these Robo Advisors who have come on, like Wealthsimple, who will take any amount of money and will still sit down with you, talk to you, and design an investment strategy and portfolio. And I don't think they have any limit. So again, you got to shop around. But I'm sure it is true that there are certain investment advisors who simply aren't interested under $1 million, unfortunately.
I'm just seeing a couple comments from people who are just able to join in now. So just to clarify, this Zoom meeting had a max participation of 100 that we had not signed up for and didn't want at all. So for those of you who weren't able to join until just now, we're really sorry. This is all recorded and we will send the slides and the recording after. And so that's just to answer those questions. Karen asked a question, I think off the back of the TFSA beneficiary. The TFSA beneficiary and or RRSP, can that be more than one person who's the beneficiary, Michael?
I'm not sure, to tell you the truth. I don't know. I know in the TFSA, as I mentioned, you can have a number one beneficiary and then a subsidiary or subsequent beneficiary if the first person has deceased, for example. I don't know the case for RSPs. No, I just don't know.
Okay. I have a question on, I'm guessing this is directed to you, Michael. Do you hold ETFs or only stocks, gold?
In my case, for the most part, I own ETFs. I own some individual stocks. I'm not sure, am I better off owning individual stocks or ETFs? I really not sure. I can tell you this, that in my daughter's portfolio that I manage for her, it's predominantly in ETFs, 90%. It predominantly is in things like balanced all-in-one ETFs. And I can tell you that her return beat mine by a lot last year.
I heard that. That's good to know. We have a couple questions on TFSA. So Nick Vick asks, can one hold the shares of a private corporation in an RRSP or TFSA? That one, Michael.
Yeah, again, I think that's more of an accounting question. I'm not sure. I think that's something you'd have to check with CRA on their website, but I'm not sure.
Great. Could you talk about, Michael, the redeposit of TFSA withdrawal and any tax implications?
The redeposit. So, okay, so what I'm presuming you mean is that you take out, say, $10,000 from your TFSA. Can you redeposit that money? The answer is yes, but not in the same year. So, for example, if you take out $10,000 from your TFSA this year, 2021, that gives you more contribution room, and you can put that money back in, but not until 2022.
I'm just seeing that one of our participants has raised a hand in Zoom, which is great. Would you mind just writing your question, Lisa, if you have one? It's just easiest to answer that way. Thank you. Also have a question on Robo Advisors. I think you've kind of spoken to that a bit already today, Michael, and on your opinion of that. If you have anything else to add.
Yeah, I think, I think Robo Advisors could be a good approach for somebody with a smaller portfolio who still wants some professional guidance. Their fees are reasonable. Again, it's on a sliding scale, but typically under 1%. And they'll take, I think, virtually any size account, and they'll sit down with you and you can talk to a professional advisor who will talk about your needs and design a portfolio to fit you. So I think for people with smaller accounts, Robo Advisors are a good alternative.
Great. This question from Brenda, wondering from a tax perspective, are Horizon's TRIs treated the same way as a Canadian dividend ETF? Not quite sure if I understand that. Do you understand that question, Michael?
I think so. I think she's talking about the Horizon Total Return ETFs. The answer is no. If I understand correctly, the total return ETFs basically try to move everything into a capital gain rather than yields. And this is appropriate for some people, particularly those in a very high tax rate where capital gain is preferable to dividends. But they're a bit of a financial engineering approach to things. And as I say, the main purpose, as I understand it, is that all of the income and everything else is converted to a capital gain. So, and I believe also that that capital gain is only distributed, well, it is not distributed. You only get that capital gain when you sell the underlying funds. So it doesn't give you an annual income the way dividends do.
Great. Looks like we might just have one, maybe two more questions, and then we'll wrap up. So Karen was wondering, is there a situation where mutual funds are the best choice, or are they replaced by ETFs? Is the active management the same in both ETFs and mutual funds?
Yeah, good question. Generally speaking, ETFs have a lower fee. So for example, if we use the RIT ETF that I talked about earlier, talking about real estate investment trust ETFs, you can buy that as the ETF. You can buy almost exactly the same thing as a mutual fund. The difference is the mutual fund includes what's called a trailer commission or trailing commission that's paid to whoever sells you that mutual fund. And that trailing commission is about 1%. So the difference in fee between the mutual fund and the ETF actively managed is 1%, roughly. And you're getting exactly the same thing. So generally speaking, if you can find an actively managed ETF, and there are more and more of them today, they will be substantially lower in fees than the mutual fund doing the same thing. And low fees means more in your pocket. Now, you might not think that 1% is a big deal, but think of it, over a 10-year period, that's not 1%, it's a little over 10% based on compounding. And over a 20-year period, it's 20-odd%. So it does matter over time.
There is one question that Angie, I think this is our last one maybe, on REIT/RIT. Is there an ethical one for long-term care that would pass the must for NAFR concerns? I'm not quite sure if I understand the question, Angie. Michael, are you able to decipher that one?
Well, I think she's probably asking, is there a REIT ETF that focuses on long-term care homes that is ethical? I'm not aware of any ETF that focuses on long-term care homes. There are individual REITs that focus on long-term care homes. There's a number of them. Whether or not they're ethical or not, I frankly don't know. But there are definitely a number of individual REITs that own long-term care homes. More than that, I wouldn't comment.
Great. Well, I think that we've hit the end of our Q&A.